Recently, I have been actively building a position and buying into SK Hynix, trading under the ticket symbol 660 in Korean exchange. Yeah, actually, that's where all my salary went to. Currently, they are launching a 28 billion IPO ADR listing on the US stock exchange under ticket symbol SKHY, which will be available on July 10 in US time. In Singapore time, it will likely be around 11 PM based on my IPO experience with SpaceX. This stock is already up over 225% this year alone. Today, I would like to take you through exactly why I've been allocating my capital here and the data behind my thesis. Before we unpack the matrix, a critical note for transparency. I'm not a financial advisor and this video is absolutely not a product recommendation. This is purely me sharing my personal investment journey and analysis for education purpose. All investment carry risks, so please do your own independent research before putting money into the market. The primary reason I'm watching SK Hynix so closely comes down to an absolute bottleneck in the AI revolution, HBM or high bandwidth memory. High bandwidth memory is the ultra-fast RAM that powers the advanced AI processors. Right now, demand for AI is skyrocketing and it triggers a massive supply shortage. Think of it like this. Lunchtime leh. I want to eat chicken rice eh. But uncle saw already. Bo pian. Don't say bo jio. Chatterbox Cafe got sell chicken rice eh. But $27 one plate. Huh? Are you serious? Yeah, that is exactly what tech giants are doing right now to get the HBM. Yes, they are really buying the $27 chicken rice. And SK Hynix is one of the chicken rice sellers. Right now, SK Hynix is completely dominating the competition. As you can see from this chart, they control over 56% of the global HBM revenue, leaving rivals like Samsung and Micron fighting for leftovers. By locking in near exclusive deal to supply the Nvidia top-tier AI chips, they have built a massive technology moat. But here's the kicker. The market hasn't fully priced this in yet. SK Hynix currently trades at a PE of around 22, and its forward PE is around 7. For a company with this kind of monopoly, that valuation is insane. Essentially, a forward PE of 7 indicates that the markets expect a massive surge in net income over the coming year. Before diving deeper into SK Hynix, it helps to understand exactly what this valuation matrix tells us. Trailing PE ratio. This measures the stock's current price against its actual earning over the past 12 months. It tells you what you are paying for historical performance. Forward PE ratio. This measures the current price against projected earning for the next 12 months. When you see a steep drop from a trailing PE of 22 to a forward PE of 7, it signals that Wall Street expects exponential earning growth down the road, making the stock look incredibly cheap relative to its future potential. I'll do a deep dive into PE ratio in a separate video, but to summarize, when a company PE drops all the way from 22 down to 7, it tells you that Wall Street expects earnings to grow by over 200%. That means its net income is projected to be more than tripled down the road, making the stock look incredibly cheap relative to its future potential. However, to maintain complete objectivity under responsible publishing guidelines, we have to look closely at the severe downsides. Memory chips are historically a high cyclical commodity sector. In 2023, a sudden hardware supply glut forced SK Hynix into steep operating losses. While AI demand is structural right now, any sudden cooling of corporate cloud capital expenditures will cause memory price to correct sharply. Second, the competition is actively trying to break this monopoly. Both Samsung and Micron are committing hundreds of billions of dollars to catch up in advancing packaging. If they flood the market by late 2027, we will transit from a severe chip shortage to a massive oversupply, causing SK Hynix profit margin to drop. To summarize the valuation risk, it all hinges on sustained demand. If the AI boom slows down and the demand for HBM dries up, SK Hynix earnings will plummet, and the share price will crash. When you buy into a stock priced for high growth, a sudden drop in demand is the ultimate risk. I didn't just start looking at this today. I've been consistently accumulating shares of SK Hynix over the last 3 months. Given the structural shift we are seeing in AI infrastructure, my strategy remains unchanged. I'm going to continue dollar cost averaging and accumulating more shares. But this is just my strategy based on my personal risk profile and investment horizon. I want to know what you are thinking. Are you buying the current consolidation, or do you think the semiconductor cycle is nearing its peak? Drop your thoughts in the comment section below. I'll read and reply as many as I can. If you find this transparent data-driven analysis helpful, do hit the like and subscribe button and turn on notifications so you'll never miss the next deep dive. Thanks for watching. I'll see you in the next video.